In the last module, module 0.3, you learned how to calculate your overhead rate. In this module, you'll learn how to apply it appropriately using a margin formula. Applying your overhead rate appropriately is just as important as calculating it accurately. We apply a calculated overhead rate on direct labor to ensure we cover all our overhead expenses. For a service business, the basis is direct labor only. To apply it accurately, we use a margin formula, never ever a markup. Let's revisit the income statement from the last couple of modules. Our gross sales is $75,000. Our direct labor in red is $27,000, and our G&A expenses plus selling is $18,000. Our profit is $7,500. Applying the overhead appropriately using a margin formula continued, we take that $27,000 of direct labor and we divide it by, in brackets, 1 minus 0.4, which will give us, which is 0.6, divided into 27,000 will give us 45,000. 45,000 times the 40% overhead rate equals 18,000, so we covered our overhead by using a margin formula. Putting it together, assume that the income statement was for one project where our gross sales was $75,000, our direct labor was $27,000, direct material was $22,500, and our 40% G&A plus expenses is plus sales is $18,000. If we add those three things together, we get $67,500. This is our break-even point. It is a point of which we neither make money or lose money. And if we look at, we subtract that $67,500 from $75,000, we come up with $7,500, and $7,500 divided by $75,000 gives us a 10% profit. Now, putting this all together, let's assume that we have the same job to do again and we want to make the same profit. Labor is estimated at $27,000. Direct material is estimated at $22,500. Our overhead rate is 40%, and our profit that we want is 10%. Putting it still further, calculating overhead with a margin formula is we take that $27,000 direct labor, okay, estimated labor at this point, and we divide it by, in brackets, 1 minus 0.4, which is our overhead rate, equals 45,000. Overhead rate plus direct labor. It's the combined effort of direct labor plus overhead. $22,500 direct material plus $45,000 overhead plus direct labor equals $67,500, our break-even point. Using a margin formula for profit, then, we take this $67,500 break-even point and divide it by the same margin formula of 1 minus 0.1, which is the 10% profit, or 1 minus 0.1 equals 0.9, and you'll find out that we'll get back to 75,000. We have arrived at the exact same number by using a margin formula for both overhead, on direct labor, and on profit on the break-even point. In the next and last module, 0.5, we will show you how much money you will lose if you estimate using a markup. You won't even cover your break-even costs.